recording, right? Recording has started. Okay. All right. It's only 3 minutes into the class. All right. So let's So this document, fair value models, I have already created. This contains the discussions that we had over the last two sessions, and I will also include some of the discussions from the last session in your previous course, where we discussed the arbitrage-free valuation based pricing for FX cross rates. So everything that goes into models and finance, I will eventually include in this particular document, and then we can have a wrap-up session so you have a very good understanding, theoretical understanding of models. But right now we need to focus on our project, which we'll have to do because, as usual, we're quite tight. So we'll start with the OTC markets today, the topic of OTC markets. Let me just increase this here. Yeah, okay. And then I will just include one point here about the project, which is, okay, so regarding the project, I wanted to give you the tickers, okay? So these are your tickets. The project, you'll get to know the details and the background later on. But what I want you guys to start doing is already start tracking these markets, okay? So you can go to the CME page, start looking at, these are all futures contracts. So I will give you some readings as well. As you can see here, there's some readings given, okay? And you also have the readings which are there in your notes. So in your the readings that are concerned here, I mean, that we have to cover now. So our topic now is basically OTC markets, exchange traded markets, understanding how markets work. And also the connected topic is essentially forwards versus futures. And the way you'll understand it is, well, I wouldn't put it as forwards versus, let's put it as forwards and futures, okay? So forwards are OTC instruments and futures are exchange traded instruments, and we'll understand, as we understand the differences here, we'll understand the differences between these two, but they're also very similar. So this particular project is in, you've done spot trading, you've done option trading, now you'll be doing futures trading, and these are the contracts that you're going to be trading, okay? So if you open, these are all contract specs, but you can also look at the quotes. I would recommend that you go through this exercise. I will give you we will have the discussion on the case later on, but you should already start familiarizing yourself because it was going to, it's going to be, new material for you, getting used to the new markets. No, I think we'll keep the contract specs name. Let's open this so you can get yourself familiar with this. Mainly, you'll have to, you can launch this in, I don't know why it's taking so long to open up. All right, so here you have this, and so you can even look at, these are the contract specs. You can understand how these futures contracts are. You start learning about this. This project is an opportunity for you to learn about these futures contracts. These are all major futures contracts in the world, okay? These are major commodity contracts, gold, copper, and crude oil. So you'll have, so here you see the intersection of, as we said, asset classes, markets, and instruments. You can see different asset classes. You can see here commodities. Okay, what asset class are these two? Japanese yen, Australian dollar. Anybody? What asset class are these?
Yen, sir.
Yes?
Yen.
Yeah, what would be the asset class? Remember, we've done asset classes, markets, and instruments in our framework. What would be the asset class?
Dollar, because it is Universal. That's
No,
dollar to yen.
asset class. Dollar is not an asset class. So you guys have forgotten all this stuff. So this is meant to give you this was meant to be. Uh, Let me just open this here and show it to you. That's why these courses are designed in the way they are designed. You move across in different courses. You do different instruments, different markets, different asset classes. So you guys have forgotten all this stuff. This was discussed with you earlier. I think it's already there in your notes also, I think, in your introductory notes. So this is how we like to look at global markets, the right way to look at global markets. You have all the instruments, okay? You have all the asset classes, and then you have each intersection of an asset class and instrument is where you have all the markets, right? So here you have spot currencies, the biggest market in the world. So you have to imagine that in this box, you have all the currency pairs in the world: dollar, rupee, Swiss franc, Canadian dollar, Australian dollar to sterling, everything. Every combination you can think of, the NC2 kind of formula, every combination you can think of. Imagine that there are so many boxes in there, and each box is some market, like a dollar rupee, a dollar yen, dollar Canada, dollar Aussie, so on and so forth. Okay, so this is how you think about it. So coming back then, what would be the asset class for the Japanese yen futures contract and Australian dollar futures contract? What would be the currencies, right? Right. So then you're trading Japanese yen. So the way you use this framework is you get to know what you're doing. When you traded first, the first project you did, you were over here, intersection of spot and equities in your second project. And so inside that, you were actually inside a smaller box. These are all global equity markets. So imagine that in this box, you have all the world's equity markets: British, UK markets, German markets, French markets, Japanese markets, Indian markets. And then I put you into one of the boxes inside this box. And that was the US equity markets. And even there, I put you into a further smaller box because I gave you specific markets, only 33 markets that you could trade. So that's how you look at the framework. You're at the intersection of spot and equities. Now, in the second project, you were at the intersection of spot, of equities and options. Okay, this is FP options just as an example. Okay, just one example. And here too, I constrained you because I constrained you to trading in particular markets, option markets, specific option markets. You couldn't have traded everything. Now I'm putting you into several of these boxes inside under futures. These are futures are a type of instrument. So you'll be trading some currency futures. You will be trading some commodity futures, and you will also be trading some interest rate futures. Okay, I mean, you may not actually trade in the project, but we will be discussing the case as if you would trade it. Okay, so you may not actually, I may not, that's why it's not been bold. I may not actually ask you to trade. I'll make up my mind on this finally, but you should be mentally prepared to trade this as well. So this euro-dollar contract, this is a interest rate futures contract, okay, the euro-dollar futures, which is why, if you remember, when I asked you guys to do this kind of thing, when I've asked you to talk about, the way I have taught you is that whenever you talk about, you notice this thing is called euro-dollar futures, okay? When you mouse over, you get euro-dollar futures contract, okay? Now this, you might wonder, is this euro-dollar like the currency of the European Union, euro, versus the currency of the United States, euro-dollar, the dollar, United States dollar? Is it that dollar? Okay. Well, actually, it's not. Okay, it's actually an interest rate contract. That's why I told you, if you remember, you have a petroleum stock, not in good state at all. Baker Hughes. This is a petroleum oil field services company. You can see the cyclicality in action once again. But this is not what I came here to do. I get involved in market discussion. Let's look at the point I was trying to make is just to reinforce your learning. So we are having some general discussions. I'm getting you into I'm giving you a brief introduction to the markets involved in your project. Okay, so now this is a foreign exchange market, okay? This is a foreign exchange market, the currency market, euro versus US dollar, okay? Now, if you remember, I have asked you to always, whenever you're referring to this, I've always asked you to say euro dollar FX. In the context of this, I'm mentioning this because this, when I look at this chart and we say that, oh, this is the euro dollar chart, okay? And so there's also another euro dollar which is involved here, which is this one, which is the interest rate contract. Now notice that under the CME grouping, they have already done the grouping. This is a subgroup under commodities. So when you want to look at crude oil, they go it under, they put it under energy. For copper, they put it under metals. And in yen and Australian dollar, they put it under FX. But in the case of this is they put out under euro dollar interest rates. Okay, interest rates. So this is an interest rate contract. This is not to be confused with what I'm showing you here. Okay, this is the foreign exchange rate. Euro, this is number of dollars per euro. Okay, so that's why I have always told you that when discussing that, I'm probably written it earlier as well, but I'm writing it again. It's very important to be careful about these things. When referring to Euro USD in FX markets, always say to distinguish from this fellow here. You do not want to confuse. This is actually an interest rate futures contract. This is actually one of the most actively traded interest rate futures contracts in the world. We'll learn about this later. This you'll see this will also take a little bit of. You can see what this is dealing with. This is an interest rate futures contract, okay? This is talking about London interbank offer rate, okay? This is an interest rate contract. So this is a different thing. So that's why the first learning here is that we are now getting into the discussion of, we have already completed this fair value model. Now we are into the discussion and we are giving you a preliminary introduction to the work involved in the project so that you guys can start getting warmed up, okay? Because we'll have very little time. Before I get into this actual theoretical topic, I'm going through one project, a topic on the project. Okay, we are discussing the contracts. And in that context, I'm again reminding you that you should always say, when you're talking about euro dollar in the FX market, always say the euro dollar FX to distinguish from this one, because this is also referred to as euro dollar. Okay, this is a euro dollar interest rate futures contract. We'll learn about this later. You can learn about this itself. Okay, so we will be therefore doing, with respect to this, we will be trading futures in this project, and we will be trading futures, which is an instrument type, across 3 different asset classes: currencies, commodities, and interest rates. Okay, you may not trade in interest rates, but we will learn how to trade. We will learn the theory anyway. But in practice, you may not actually do it in the project. But you will set up all these things. Okay, so learn the tickers and try to set it up in the I'm giving you the tickers here for IB in the IBTWS. This is 8G. Okay, then what you do is, the way you set it up is gold is, I think, GC. Okay, Japanese yen, I don't know what the ticker is for Japanese yen. You'll have to just try and type Japanese yen and see. Okay, it should be JPY, but it may not be. It might be something else. Okay, and there should be AUD, but let's see what happens. Okay, and you have to get to futures. Now these are the tickers. You can try and set them up in IB in your IBTWS. And if you go to crude oil, if you go to quotes, okay, that is contract specs. If you go to the quotes tab, you can see what I showed you the other day. Okay, just yesterday I showed you some stuff on the futures markets. Okay, you can see all the data for the futures. You can do this to all the markets. So when you try to set up the data in your IB, when you go to CL and you try to choose futures, earlier you were choosing smart stock or you were choosing options, earlier setting up the tickers. This time you'll choose futures, okay? And when you choose futures, it'll give you an option for many, many months. Try to choose some of the near months here where you look at and see high volume. So right now in crude oil, your highest volume is in February. So try to choose the February contract at least, maybe one or two more contracts, set them up. So this is how you set up the ticker board on your IBTWS, and repeat that for all the contracts, okay? So remember, therefore, to always say Euro-Dollar FX, that's one. So these are your markets, get familiar with them. Try to also go to this and try to understand. So here you'll be doing, although you'll be trading futures for the currencies, let me show you currencies first. Although you'll be trading them as futures, okay, but you should track them as spot currencies. So therefore you should be tracking these two. I don't know if the JPY gets picked up. Are you guys all following? Anybody, any questions? Please remember, you have to ask questions. If anything that you don't understand, you have to ask questions, okay? Otherwise, there's no point if because I can't see your faces. So you have to ask questions whenever you don't understand something. So you have to set it up like this. This is, you can see here. And now you have to start forming views, okay? You have to start forming views on these markets because you will have to trade these markets from a slightly different perspective, but you still have to form a view on these markets. This is dollars versus Japanese yen, dollar yen. Yes?
So, like you were saying, to form the view on spot markets. So does that mean that the spot market affects the future market as well?
It does. It does. The futures market is actually going to be, in the case of, it differs from asset class to asset class. But in the case of currencies, see, in every market, this is something you'll learn as you trade more and more. You'll get to know the contextual information. So in every asset class, there is a particular type of setting. Okay. So it so happens that in currencies, there'll be some market which is the most liquid market, okay? Some instrument where there is the most liquid market. So in the case of currencies, that happens to be spot. So most of the world's global volume in, most of the world's volume in currencies goes through the spot market, not through futures, forwards, swaps, or options, but through spot. So therefore, this drives all the others, okay? So remember, this is like an underlying. That's why it's under underlying. And these are derivative markets. So they can't move too far out of line with this. So you're right in the sense that the spot will drive the futures. So you will learn a lot about how to trade individual markets and how to track them as well. So in the case of futures, in the case of foreign exchange, and it'll be different for different asset classes, okay? So in the case of foreign exchange, the good practice is to do all your tracking. Even if you're trading futures, you're going to be trading two futures contracts, but the tracking and the view formation should be done by using spot charts. Are you following what I'm saying? What's up? Does it clarify your doubt?
Yes, sir.
Okay, so it may sound a little complicated. That's why you should ask questions whenever you have any doubt. The slightest doubt also, you should ask questions, because eventually what you're going to have to do is you are going to have to trade in these futures contracts. And in order to trade, you will have to have a view. And how to form a view? Well, you can also use fundamentals, but it's easier to learn how to use technicals. It's simpler. So because we have very limited time, you can also use fundamentals if you want. But I'm going to teach you mainly from a technical point of view because that is easier to implement, okay? So, and easier to pick up as well, just looking at trends. So you'll have to form a view by looking at the charts. So you'll have to have charts of each of these. For foreign exchange, I would suggest you go for this, okay, for the spot charts. So you have to set up the dollar yen. You have to set up the Aussie. I generally go for Rwanda, but you can go for FXCM feed also. So here you can see the Aussie chart. This is a long-term chart. Okay, once again, you can see a cyclicality and all that. Now you'll have to form a view. So then eventually come closer and look at a 3-month or 1 month or whatever, and then eventually form a view on the Aussie. Which way is it going to go? So for Aussie and dollar yen, you should form your view by looking at spot charts, and then eventually I'll show you how to trade on futures using futures contracts. It's the same. When you set up the futures contracts in your IVTWS, you will see the bids and offers. So if you're selling, you will be hitting the bid. If you're buying, you'll be hitting the offer. So the same trading logic will apply, right? So these you have to set up. As far as, let me show you. So I've shown you the two here. Okay, so for JPY, the chart ticker is USDJ. You don't have to set up that. You don't need that. I'm just writing that here. Okay, these are the chart tickers that you need. Okay, AUD USD. Let me bring the chart a little closer to this. So here. Now, what are the other ones? Now, for crude oil, just type CL. Okay. Try to go for, we want, what we want is, we don't want futures, because you'll notice here, when you start looking at futures, it gives you many options. Okay. Continuous contracts. We'll discuss what these are. Here you see the Feb contract. Again, this is not the right way to chart it. So for crude oil, I would say that you type US oil. Okay, so this gives you a CFD. This gives you a spot type of chart. So use this. Okay, so if you look at a 5-year, so you have to type US oil. Is that what I typed? US oil? Yeah, US oil. So I'm writing that here, the charting thing. So you have to remember what this is for. Okay, this is for charting on this particular platform. Okay. So this will give you a spot type of price that will be better to chart. Okay, now let's see if we have some copper. So again, so the thing is, you have to look at crude oil and take a view on it. Practice taking a view on these markets. Get used to it, because it takes a little time to get used to it. Because once the project starts, you'll have to be trading quite rapidly. So therefore, you must be in the groove and ready to take views. Okay, so crude oil. Then for copper, let's look at, I think we would just look for copper. We're looking for the CFD and see if we have anything. These are again copper futures. You can track them. You can look at no, you don't use MCA. Please do not use, guys, do not use these Indian exchanges, okay? We need to have COMEX copper, okay? This is 8G. Use this 8G code. So this is one. Let me see if there's this is a continuous contract. These are actually not very good. You know, I'm trying to see if there is a we need to set up there used to be a copper price. Where is the copper CFD? These are all futures contracts. Okay, I'll try to set up something. I'll try to find something. In the meantime, you try to look at these. Don't look at MCX, okay? Look at, let's use 8G, and let's use the continuous contract and see that, okay? Current contract in front, next contract in front, okay? Let's go with the 8G one. This is a continuous chart. Let's see how bad it is or how good it is. It's okay. It's not too bad. Yeah, you do get an idea about what's happening in the copper market. Okay, so this is so please remember 8G. Do not use MCX charts. This is COMEX. COMEX is a division of the CME. You will find, maybe you'll find some charts here as well. I don't know if these guys are providing charts here. Yeah, there are some charts here as well, but these may not be very good. Okay, so I think you get a pretty good idea from the continuous charts using the continuous contract. Choose the front month continuous contract. We'll explain what these are. Okay, so you get a sense of what's happening to copper prices. So so we will go with the 8G continuous. So let's look at the ticker here. 8G1 exclamation. Okay, let's test it once more time. 8G1 exclamation. And what happens? Yeah, you end up with this. Okay, good. So we will write this HG1 exclamation. All right. Gold, I think we should be able to get a good CFD chart if we ask for gold. CFD TVC, let's look at Oanda. Do we have anything from Oanda? Yeah, let's look at this one. So for gold, we'll write XAU USD. That will give us the Oanda chart for the gold CFD. That is what we want, okay? So that gives us, this is our all chart. So you know what's happening in the gold, in the case of the gold price. Okay, it's already gone to all-time highs. So gold is at all-time high. This is the international market for gold, which is gold in terms of US dollars. So two assets here are gold and US dollars. Okay, so 1 troy ounce of gold, how many dollars do you need? A little less, around $1,800 right now. Okay, so you need to pay 1,800 US dollars to buy 1 troy ounce of gold. So use this. So you got to use XAU USD. So your ticker here for the chart is XAU USD. I think we got all the tickers done. As far as the euro dollar is concerned, I don't know if you can. This is ED actually. Yeah, euro. No, this we don't want. We want something from the CME actually. I think the CME is not available actually. Yeah, we don't need this. We won't even track it like this. We actually what need to track is 3 month. Okay, yeah, so these are actually GE. These are actually GE1 continuous. Okay, you notice CME. Okay, if you see here continuous contract, this looks quite funny. This is not how you're supposed to track it. So, but you can use it for later on for trading. Okay, which is, so this is GE1 exclamation. I'll put the ticker there later. This is GE1 exclamation, but don't worry about it right now. Actually, you should be using the 3 month cash deposits. So we'll come to the trading of this later on. But this, as I said, first, mainly don't worry about this so much right now. Focus on these 5 markets, okay? Yeah, these 5 markets, crude oil, copper, gold, dollar, yen, and Aussie. Get familiar with them and start forming your views on them. So that let's try HG1 one more time, HG1 just to test. Make sure that we have the right one. Yeah, copper futures, very good. Okay, so make sure you familiarize yourself with what has to be done. I mean, at least start for, one thing you have to do is you'll have to form views on each of these markets, so understand what's going on. And also don't form just a technical view, also teach yourself to trade as of, to look at things from a fundamental point of view, okay? And so for that, you can use this is some of the, one of the reasons, some of the benefits of doing this project is that you get an opportunity to make yourself familiar with these different markets, which are very important markets. These are three of the most important commodity markets. Copper is very important for global industrial activity, and copper prices are used as a bellwether for the global economy. So here you can see the pickup in copper, which is basically, many people would use this as an indicator that the global economy is going to recover quite well, okay, from this pandemic. Okay, so you see here where it is, and so this is what, April 20. So this is like the pandemic, and now it's recovered to new highs. So the copper prices, that means that the market is saying that the copper market is saying that the global economy is likely to recover quite sharply because copper prices are going up. So these are very important markets. Start, and then also start, as you are following them from a technical perspective, look at the price action. Also go to, I think in overview, you will get some information on the fundamental side. These guys have, this is a very good website. Okay, I've always told you not to follow random websites on the internet because there's a lot of garbage on the internet. But this is a very good website. You can learn a lot over here. Tremendous amount of learning. You can set up your own ID, create a login, and you can learn a lot here. And you'll see some videos, and you'll see some discussion on fundamental aspects here, articles and reports, resources. You can follow this stuff. Sorry, I'll just have a sip. So this is how you set up for your project. In this project, you will be trading these markets. And so we'll have our own, we will get our training in terms of how to trade. We'll get some learning from that. And we will also learn a little bit about the fundamentals of each of these markets by using this opportunity to do some research. As you form your views, try to read the daily bulletin, okay? And read all the other stuff, articles, reports, okay? This is a very important contract. This is the North American crude oil benchmark. So read about these things and get yourself familiar, start practicing, and then we will eventually get into the case and the framework for the decision making, okay? So that's as far as, this is the introductory module in terms of your introduction to the project, getting you guys ready, because as usual, we have very little time. Okay, so now let's get into this, which is your OTC markets versus exchange. Any questions at this stage as we move in?
Sir, what is the meaning of continuous contract? Like if there is no expiry date, how do we calculate implied volatility in case of options? And sir, in case of futures, what is the difference there?
Sorry, Siddharth, your audio is not very good actually. Yeah, I got that part, continuous contract.
Yes, sir. Sir, what are those? So it's something about the expiry date, or is it like the options with or futures with expiry are stacked in a continuous manner, so there is no effective expiry?
Yeah, so basically what happens is the continuous contract, so Siddharth is asking about this, you notice this peculiar syntax with the exclamation. This is how these guys are tracking the continuous contracts. So continuous contracts in futures, they appear in futures trading. We only use them in the case of futures. So here, the reason they are required is that we want to see, like here, you see it's so nice, you can see so much data from 1989, how have copper prices behaved, because you need to get that perspective, the long-term perspective. So at the same time, the problem is, in the case of futures contracts, as you can see, if you look at the quotes, I showed you the quotes from yesterday from bar chart as well for crude oil. You saw that there are many, here, you can see, if I make this, you can see all these contract months, okay? So what's going to happen here, obviously, is that So Siddharth's question is quite valid actually. So I'm discussing it here in the class itself. So he's asking about continuous contracts. So yeah, okay, we accept their cookies. So now you can see here the contract Feb 21, March, April, May, June. So what's going to happen is as these dates arrive, okay, these contracts are going to expire, okay? Just like you had when you were trading options, you could see options for different maturities. So just like that, futures also have different maturities. And as these maturities arrive, as these dates arrive, the contracts expire, okay? So then what happens is that if you are trading the February contract, okay, then what will happen is after a few months, this will expire and your chart will not have this much data. So the way you do a continuous contract is you basically, that's why you notice that this is the first continuous, okay? 1 exclamation. You can also have 2 exclamation. That is the second continuous, which means essentially what if this is of course crude oil, but if you did this for the first continuous at this point of time would be tracking Feb 21. Okay, and once the Feb finishes, it will start tracking the March 21 because that will become the first contract. Okay, the first front month. This is called the front month. In futures trading, we use these kind of terms. This is called the front month. Okay, so right now Feb is the front month. So if you're plotting a continuous contract, you notice the prices are different. 24, 36, okay? Even though these are just adjacent months, the prices are different, okay? So initially you track Feb, and when Feb rolls off, you track March 21, okay? That becomes the front month. And then when March finishes, then you track April. That is if you're doing the front month continuous. If you're doing the second month continuous, at this point of time, you would be plotting March. When March becomes the first month, you will be plotting April, and so on and so forth. Okay, so every day you would take their prices. Otherwise, it's the same way of tracking. So continuous contracts are a way of getting long-term. The reason you do them is because you want to see long-term price action history. You want to see the long-term price history, but there is a problem that futures contracts keep expiring. So that's how you create continuous contracts, right? Yeah, does that answer your question, Siddharth?
Yes, sir.
Yeah, okay. So these are continuous contracts. Okay, so yeah, where was I? What was I saying before we got to this discussion? Okay. Never mind. Okay, so I was telling you to also use the opportunity to read, go to overview, see what resources these guys have. There's an education tab for CME Group. This is a very good website. Okay, you can learn freely from here. They will not learn any garbage on this website. So anyway, so this we can keep, I guess, for a while. And okay. So we will now get into this discussion. So this is our theoretical discussion on, yeah, I was going to get into this and then I asked for questions on the previous module. So we're going to start this topic, OTC markets versus exchange traded markets. So you can find your notes here. So one is that you can refer to. There's no sequence for this. Try to read this up as quickly as possible. Okay, and then if we have questions, we'll handle them. Okay, one more thing, I'll just remind you guys, please remember that I'm reminding you once again for all your textbooks, all the 3 textbooks, you would have noticed that there is an Indian author, and in the Indian author has added in every section, it's your responsibility to find this. Every section, every chapter, maybe not every chapter, but many chapters. There is a section on Indian markets. So you have to read those sections and ask me if you have any questions. I'm not going to cover those because those are like mainly like information. Okay. So therefore you have to read it, but you have to be aware of that. Okay. You need to know that information. So you read it, it's your responsibility. And then if you have any questions from there, you ask me and then I'll answer them in the class. Okay. Because that stuff might be handy in your interviews. So they may ask you questions that you can answer with information that you pick up from there. So please do that. So as far as your readings are concerned, go to Hal Basu, cover these chapters, okay, as quickly as possible. And then, of course, in our own notes, we have this, okay. This is what we are doing. So we have to cover all this now. So we start with, so please make sure you read all this. There are 4 notes. So our first note is essentially over-the-counter markets, OTC markets, okay? All right, so OTC markets and exchange-traded markets. I'll actually show you, this is there in, there is a website, one of these notes here, okay? We can use that as a starting point. This is 4.3. In note number 4.3, which is differences between, there is a link to a spreadsheet, okay? This spreadsheet, you can see, this is basically, this can be used as a sort of a guidepost to give you the bullet points, and so that we can eventually understand what is going on. So we'll have a discussion on these things. So let's start with an understanding of OTC markets. Make this. Okay, so before we get into this, once again, you have to remember what is a market. You have a three-level definition. General definition, goods and services. In financial markets, we'll leave out the services part, okay? Give a general definition, 2 assets exchanging 2 assets for one another. And then we give a highly specific definition where, because one of the assets is always some currency, so it's exchanging some asset for money. So if you go back to your asset classes, so it could be any of these, any of the asset classes, currencies, commodities, equities, debt, real estate, okay? Could be any of these. It could also have what we call minor asset classes like collectibles, like you could be even trading in Rolex watches. There are some people who trade in Rolex watches, or Harley Davidson motorcycles, or Ferraris, luxury cars. So those kind of things. Those are minor asset classes. So those are we call them collectibles. So those would also be examples of markets. Okay, so you would trade each of these, any given asset. So within this, you will have several assets. Within currencies, you could have Aussie, you could have yen, you could have Canadian dollars, and you will be trading any of them against another market. Okay, so that's how you would be trading this here. So this is what the definition of market. So final third definition, which is the working definition for us. You exchange. So given this now, so remember that markets are venues for exchanging money, assets for money. And if you notice that we have written the venue in 2 ways, okay, physical and virtual. So this in fact gives you a good introduction to the differences between exchange traded and OTC. So in future, I'm just going to say, I'm not going to say this big word, exchange traded. I'll just say ATM and OTC. I won't even say OTCM. Okay, so in future, so when I say OTC, that means I mean over-the-counter markets. And when I say ETM, then I mean exchange-traded markets. Okay, so these are very big words. I'm not going to say them again and again. Okay, so here we are, physical versus virtual. This gives you a very good understanding of introduction to how to understand the difference between the 2 types of markets. Okay, so okay, so you have 2 types. So historically, we've had 2 types of markets. We use these 2 terms, OTC and ET. Okay, so that's why you notice even here in our framework, I have a category, I have a classification for that. So some are classified into different kinds of, so like in spot markets can operate either as OTC markets, which you get in the case of foreign exchange. Okay, so the spot market for currencies, that's an OTC market. But the spot market for equities, those are exchange traded. Okay, so that's why this labeling is like this. On top of spot, this is a type of instrument, and these are types of markets. I've got both of these because you can have spot markets in currencies that would be OTC, in equities there would be exchange traded. So therefore, I have to put both. In the case of cash, this is purely a cash market. This is a purely OTC market instrument. So there's only OTC over here. Again, in same thing with options, you can have both. Forwards are, you notice there's no ET markets here. Okay. Forwards are a purely OTC market instruments. Okay. So that's why you see forwards are not here. So you can learn about this also. I mean, of course, what are OTC markets? What are OTC markets? What are exchange traded ET markets? And what are the technical differences? We will learn those over the next few sessions. But at least at this point of time, you know that there are these two terms which are referring to two different types of markets. And so you can also relate this distinction between the two types of markets to the stuff that you have already learned before. Different types of instruments, different types of asset classes, okay? And you can connect these by looking at this framework. Right, so let's look at it. We have two forms, OTC and ET, okay? So you can see here, you can read this stuff. This, I think they have actually removed this link. So they have removed this link. Let me see if I can, hopefully this is the link that opens. I already have it open somewhere else. Yeah, okay, good. So this gives you a good idea about, because these guys had a very good Forex market, Forex trading hours applet, but that's not working right now. So they've changed the design. So this gives you, the main thing about OTC markets is that there's no fixed location. Okay, so it's a bilateral trading situation. There's no fixed location. And their connection is through communication networks, okay? So you can think of it like if you have a bunch of people connected through WhatsApp group, that's also an example of a communication network, okay? And usually, of course, they have much more sophisticated software. You will have Reuters dealing machines. You have things like EBS, various types of trading software. But you could also have a simple thing like a WhatsApp group where people are posting prices and trading with each other. That's also a communication network. So there's no fixed location and there's communication network. Okay, so let me give you an idea here. These are the key elements here to understand in the case of OTC market. So you have the global foreign exchange is a good example of an OTC market. And in fact, all global markets operate like this. So imagine this. Let me go to F11. Okay, so you can see we don't need to see the time, so I can bring this down a little bit. You notice a pattern here, guys? As
Yes. So
yeah, what is happening here in the pattern? If you go left to right, like we read, we are going, which way are we going? If we go left to right, top to bottom, what is happening? Is there any pattern?
yes, sir. It is a time. According to sir, time decrease from 5 to 4 to 3 to 2 to 1.
Yeah, so it is moving, it is following the sun as it goes from east to west, right? The first country that has, the first big country that experiences the sunrise is New Zealand. So in Wellington, this is the FX trading center for New Zealand. So Wellington starts trading first. So that's why we say that the global foreign exchange markets operate from early Monday morning in Wellington all the way to, they never stop 24/5, and they trade all the way into the Friday closing in New York, okay? So this is how they work. They go around the clock and they go all the way up to New York. So I've given Chicago. Chicago is also a very big financial center. These, the CME Group website that I showed you, that CME used to be Chicago Mercantile Exchange. So futures trading is centered in Chicago, in many futures trading markets, even option trading markets. So Chicago is also a very big trading center. It's 1 hour behind New York. but generally foreign exchange market stops in basically New York close. Okay, so Monday morning Wellington to Friday night, Friday evening New York time. Non-stop trading in global foreign exchange, the biggest market in the world. So imagine this. So this is how an OTC market works. So you have Bank of New Zealand Wellington. Let's say you have NatWest, National Westminster Bank in Sydney. You have Sumitomo Tokyo. Then you have DBS in Singapore. You have UBS in Zurich. You have, let's say, Barclays in London. You have Citibank New York, and you have in Chicago, let's say JP Morgan in Chicago. Okay, and you have all these guys are trading with each other. So everybody's connected to everybody else. Okay, so Wellington can be calling Zurich for a price. London can be calling Chicago for a price. And then, so they'll call for a price, they'll be quoted a price, and price maker, price taker, the same dynamic applies, and they will buy and sell. So the point to understand here is that these are all bilateral. There's only one transaction happening. So if BNZ Wellington, Bank of New Zealand Wellington, does a deal with UBS in Zurich, okay? So let's say they do a 6-month forward foreign exchange deal. Okay, so they would be here, 6-month forward foreign exchange. So they would do a deal where they, let's say they are selling dollars and buying Swiss francs 6 months from today. So they, sorry, one second, I need to drink water. Okay, so the deal, remember, I need to go out of F11. Remember this. Transactions as contracts to exchange assets, transaction date, settlement date. So we do the deal today. Today is the transaction date. Settlement date is 6 months later. Okay? This is what is happening. So the deal is done today, BNZ Wellington and UBS Zurich. Dollar versus Swiss franc, 6 months of forward settlement date. Okay? So they do the deal and they're sitting tightly, comfortably. But then what happens is, as the settlement date approaches in the 6 months later, then Bank of New Zealand Wellington goes bankrupt. Okay, suppose these guys go bankrupt and they are not able to pay. So suppose they were supposed to send the dollars. Okay, they were supposed to send the dollar. They were selling dollars, and these guys were buying dollars, and they were buying Swiss francs, and they're supposed to send dollars. But if they go bankrupt, let's say one day or early morning in Wellington, they declare bankruptcy. Okay, so they don't get to send 6 months later, the day on which they're supposed to send the dollars. Those dollars are not sent because they go into bankruptcy. The receiver comes in, he says, okay, no, we can't pay money to anybody, stop all payments. So they don't pay. Now, these guys may have been more organized, being Swiss. They may have already arranged for the payment of the Swiss franc. So they have already sent out the Swiss francs to the Nostro account of this BNZ Wellington. So they are sending the Swiss francs out. They are expecting to receive dollars, but they don't receive dollars because these guys have gone bankrupt. Okay? So therefore, this is an example of credit risk, okay, which is there in every kind of, pretty much in every kind of transaction, okay, especially in the forward transactions, you have this kind of risk. So the problem here is the dynamic of the OTC market is that these guys are stuck, okay, UBS Zurich, they can, of course, they'll sue the receiver, okay, they'll sue the receiver saying that we are owed this money. But that's a very long process. You have to go through the courts, and that may take months, if not years. And so they're basically stuck because they were supposed to have received the dollars today, but now they have to litigate in the courts. So this is basically the problem with OTC markets, is that you have this is called counterparty credit risk. So when they do a deal, BNZ Wellington, UBS Zurich, these are the two counterparties to the deal. Okay, it's an OTC market deal. They are the two counterparties. Now, the risk that either these guys can't pay or these guys can't pay when the time comes for payment, this is known as counterparty credit risk. Okay. So in OTC markets, what is happening is this counterparty credit risk is being managed by these two people themselves, the counterparties themselves. Okay. So that's why you see the first point, not really the first point, but one of the important points. There are there are 5 differences, but the 2 important points are like this. Okay. So this is the main thing that now you see. They have got Zoom even in sheets. These guys are very good because they keep improving. Okay, so you can see this in OTC markets. The example I just gave you. Okay, counterparty credit risk is managed directly by the counterparties themselves. Okay, we'll come to all this later on. No daily mark to mark. It is directly managed by counterparties themselves. What I mean by that kind of statement is that they are taking, when UBS Zurich is trading with BNZ Wellington, they are taking the risk of BNZ Wellington not paying, and vice versa. These guys are taking the risk of these guys not paying. Okay, so in that sense, I mean that's what I mean by saying that it is managed by the counterparties themselves. Okay, they may have some ways of dealing with these problems. Usually what people do is they will have certain limits that we won't trade for more than $10 billion of settlement value in a day. Okay, so they have these kinds of limits. That's how they manage it. Okay, this is exchange traded. We are an OTC. Okay, so I basically went from one point of no fixed location and communication networks, and I actually directly jumped to the 4th point because this is one of the most important points. Okay, so I didn't cover the other 2 yet, but you already got the idea. There's no fixed location. So the global foreign exchange market, if you go a little bit more on no fixed location, it operates like this. It's a very good example of an OTC market. And these guys operate like this round the clock. So many of these centers, they have night desks. So BNZ Wellington, being a big New Zealand bank, will have a night desk. So even after Wellington, now see 6 o'clock in Wellington, these guys, officially the market is closed, but the night desk is open. And you see in Tokyo, the night desk of BNZ Wellington can trade with Tokyo. It's only 2 p.m. there. London is not yet opened. Zurich, not yet open. Actually, generally markets open around 7:38. Okay, so 8 o'clock, you can say it's open. So there's not yet a couple of hours more, but Singapore is open. So they can trade right now with Sydney, Tokyo, and Singapore. Okay, the night desk is open. Later on, but they will stay open around the clock. So the night desk in Wellington will stay all night and then hand over the positions to the day trading guy, the day desk. Okay, when the guys come in the morning. Sometimes they run 3 shifts. Okay, so you'll have one morning shift, early morning, and then you'll have a late afternoon shift, and then you'll have a night shift handing over to the morning shift. So this is how the big banks in the major centers, okay, so the major foreign exchange trading centers are Tokyo, Singapore, Sydney also fairly big. Sydney, Tokyo, Singapore in the Far East. Then, of course, in Europe, you have Zurich, and London is the biggest market, okay? And then, of course, in the US, New York is a very big market for foreign exchange trading, and also Chicago a little bit. So this is how in the big centers, all the like City, New York will have a night desk, okay? Barclays London will have a night desk. These guys are trading all through they're open all through the night. I mean, they're 24/7 basically, 24/5 they're open. So this is how they have, this is what we mean by no fixed location, connected by communication networks, they're trading with each other. It's a market, but there's no fixed location. All right. So that's one. And then you also understood the point about counterparty credit risk. Okay. I am just highlighting this part. Okay. This we have already shown you there. Okay. Now let's look at some of the other points. This Global Financial Centers is launching that link. Yeah, there is no listing or yes.
Sir, you said that there is no counterparty credit risk, but sir, in case of like CME group, uh, they may be managing some of the risk of the parties by mediating.
Yeah, so we'll come to that. We are now. You're talking about CME Group is an example of a ET market. We are talking about OTC right now. Okay.
No, sir, but you showed us a report where there were like two parties interacting, and the CME was the clearing. They were mediating for, I guess, clearing or
When did
some
I
other.
show you that? When did I show you that? Have I already
So,
covered this topic?
uh, sir, one time you showed us a report. There was a image there
Okay. Yeah,
where it was.
I would have showed you the CME Clearport brochure. I would have shown you the Clearport brochure maybe that there is blurring of the distinctions. Under blurring of the distinctions, there may be an image of CME Clearport. So you might have, yeah. So we are coming to that. So that's a ET market feature. Okay. So we are coming to that. Right now we are covering OTC markets. So if you click there, you might find, even on the CME website, you will find, okay, so here you have Clearport. You are probably referring to this image. I don't know if we have the picture here itself. Um, you're probably referring to this image. I know what you're referring to, this one, the Clearport brochure. And but that's an ET market. We have not come to that yet, okay? They have changed it now. They have changed the link is dead now actually, so we'll have to find it later on. But anyway, I understand what you're saying. Wait for that. That's actually a later. We are now doing OTC markets. Okay, is that okay, Siddharth?
Yes, sir.
Yeah. So you just wait for that. Okay, let me cover some of the other important points on the OTC markets. Okay, so I will not go in the numerical sequence. Let me go by importance. Okay, so these first 2 points, I hope everybody has understood that counterparty. You understand what counterparty credit risk is. If you don't understand this point, it's very simple. You can think of a simple example. Like most of us are familiar with the local grocer. So the local grocer, the kirana person, is selling to most families in the neighborhood, and with most families he has a credit line, right? So you don't pay every day, maybe you pay him at the end of the month. So that's also an example of where he's taking, because technically if you tell him at the end of the month, I'm not paying you, there's not much he can do. All he can do is next time he won't sell to you, but he can't really do much. So he's taking the credit risk of the customers not paying. Okay, he's selling on credit, and he's taking the risk that the customer will not pay. These are also like OTC markets. We don't really think of them as OTC markets, but I wanted to give you an example of where something you can identify with, which is very similar to this, that two parties trading with each other, and they are taking the credit risk of each of the parties. Okay? Sometimes a family might maintain a credit balance with the grocer, and then the grocer might not honor the credit balance or may refuse to send goods. So the family is also taking a credit risk. So, so this is what is meant by credit risk management. Okay, so I'll tell you the other point. Okay, instead of talking about the sequence, following the sequence, the other important point which we said, which you can also follow here, which is the point about customized contract terms and standardized contract terms. So since we are covering OTC, let's talk about this. So you have customized contract terms, okay? Which means you can have all kinds of, normally, for instance, when people trade foreign exchange, they trade in $1 million lots. Okay, so if you say $Swiss in 10, if you call somebody and say, I want $Swiss in 10, that already means that when you're trading in these markets, in the foreign exchange markets, the main instrument is spot. So you don't even have to say spot dollar Swiss. If you just say dollar Swiss in 10, that means it's understood that you're asking for a spot price. And dollar Swiss in 10 means $10 million. And you're referring to the base currency. The amount is referring to the base currency. So if you just say dollar Swiss in 10, many things are understood. It's understood that it is spot. It is understood that you're talking about 10 million US dollars, because in dollar Swiss, the base currency is US dollars. So all these things are understood. Now, this is how the big banks will trade with themselves. But if you are, let's say, a corporation, okay, and you want to do a foreign exchange transaction, you can ask for a non-standard amount. It need not be around $1 million. You can ask for anything. 10,345,123. You can ask for these kind of amounts, and they will do it for you. The banks will do it for you. So when you have a customer dealing with, so if you go back to this, so if you have UBS Zurich, okay, so you have, let's say if you have Nestle, if you have the corporate treasury of Nestle that needs to sell, say, some odd amount of US dollars against maybe a different currency, against Australian dollars, because they will have a business in Australia as well. So maybe they want to do a trade in Aussie US. So they will call up UBS Zurich and they will mention the amount. They'll have an odd amount, okay? And it won't even be, it'll be a forward date, but it will not be a maturity date. It will not be a rounded, in the sense that normally when you have forward prices being quoted, they are for, if I just try to call up the Netanya forward rates, I'll just pull them out. In the meantime, so the point is that Nestle can ask for an odd amount. So 10,350,199 US dollars against Swiss francs. They can ask for an odd maturity date. That means they could ask for a price where the settlement date, transaction date will be today. The settlement date will be maybe 7 months and 9 days, something odd like that. Okay, not a round amount of 7 months. So they can ask for that, and UBS Zurich will quote them. So this transaction happening between Nestle Treasury and UBS Zurich, this is also an OTC transaction. Okay, this will also be an OTC transaction, and that's why they're able to get odd amounts. Okay, odd maturity dates. You can do all of that, and you can also deal in terms asset amounts. Okay. Normally, you deal in the base asset. So if you're dealing in dollar Swiss, you will deal in US dollar amounts. It's understood because that's the base asset. But in OTC markets, you can say, I need a price in a Swiss franc amount. I need a dollar Swiss. So in this case, you will say dollar Swiss in 3.268 million CHF. That's the code for Swiss franc. Okay. So therefore, so you will say basically that you will say something like now this tells you that you're asking for a price in this amount. This is the code for a million, okay? And you are asking for, when you write it like this, that means this amount is not in the base currency, it's in the terms currency, it's in Swiss franc. Okay, this is how you write it. So you can do all this stuff. Okay, you can do all these things. You can have non-standard maturity dates, amounts. You can deal in terms asset amounts. Okay, all these things are allowed. And that's basically the idea. So this is the advantage of OTC markets. The two most important features of OTC markets, and once you understand this, then you will also understand the contrast with ET markets, that the two most important features are these two. Oddly enough, although this is a very basic topic, I found it very difficult to find a textbook where they have highlighted these two and listed the differences properly. Because this is not a very hi-fi topic, but it's still not been covered properly. So anyway, so these are the two important topics. So customized contract terms is the second important feature of OTC markets. And this is basically why people use OTC. So as you can see, point number 4 is a negative. Nobody is going to like this. Point number 4, that I have to manage the credit risk myself. Why should I have to do that? I don't want to be taking the credit risk. But it is, for instance, let me just put this here, non-standard maturity dates. Let me put the link here. The link I'm putting is a link to the net Dania forward rates, and I'll show you the forward rates just for your familiarization. You can see how these are foreign exchange forward prices. Okay, so you can see bid and offer prices. Hopefully, we'll have the time to understand how these are derived. Okay, these are derived using arbitrage-free valuation techniques using a principle called cover interest parity. But right now, what we are trying to show you is that when you look at foreign exchange forward prices on a Reuters machine or any other Bloomberg or any other market data terminal, they are going to show you price. Nobody's going to show you prices for 7 months and 9 days, 2 months and 14 days, 2 months and 14 days. No, they're going to show you rounded maturities. Okay, 1 week, spot to 1 week, spot to 1 month, spot to 3 months, spot to 6 months, so on and so forth. This is the standard maturities. Okay, this is how the market is quoting. So when the big dealers deal with each other, when the big dealers are dealing with each other, they are dealing in these standard maturities: 1 month, 3 months, 6 months, 1 year. But the advantage of OTC markets is that if Nestle wants a price, they can ask for a price for 3 months and 17 days from their dealer. Okay, that's possible because it's an OTC market. All right. Yeah. So that's basically the second point, customized contract terms. So as I was saying, these two kind of balance each other out. Okay. As you can see, number 4 is a negative. Nobody's going to like this. It's a negative. But so the question might arise, why do people even bother to trade in OTC markets? Well, the answer lies in number 5. Okay. Because most businesses, they want some kind of customization. Okay. So therefore, that is one of the reasons why people use OTC markets, because you can also structure here. I've only given, we can have one more example. Which we call problems. Okay, so you have, so this is what the other thing about the OTC markets, the other aspect of it is that you can have a highly customized, just elaborating on this point, that and structures actually, basically, okay? Deal structures. let's fit everything into. Yeah, I don't want this going. Yeah. Move this. Okay, that's the thing. So you can come up with, there's no end to, this is one of the reasons why people stick to OTC markets, because especially a lot of corporate customers, because there's no end to the amount of creativity you can use to come up with unique kinds of deal structures, because every business has a peculiar kind of a setting. They have odd kind of requirements, and they don't want to be tied to specific standardized contract terms. So they want to have flexibility and the ability to design unique deal structures. So all those things are possible in OTC markets. So that's why people use them. So the reason that OTC markets still exist is because they provide this high flexibility. Okay, and they also have many other advantages, like they are not very regulated. So they operate. For instance, global foreign exchange markets, these are the biggest markets in the world, and they are OTC. Okay. They trade about $5.1 trillion of volume every day, and they're OTC markets, right? So this is basically the structure of OTC markets, as you can see. And then I'll just go through briefly the other points, that obviously there is no listing requirement, okay? There's no listing. You don't have people like the SEC or SEBI saying that, you need to, or the European Union, the European Commission coming out with some directives. They have a listing directive in the EU. You don't have all those requirements. You can trade anything. So these guys in the OTC market, if they're happy trading some market instrument combination between themselves, they can just trade it. There's nobody to tell them, this has to be listed. They are trading it because they are happy to trade it. Okay? They're all comfortable with it. They don't need a regulator. And they're just trading it. There's no listing requirement. So that's the second point. Okay. No fixed location, you understood. Low transparency. This is becoming less and less true, but the point here is that sometimes in certain cases in OTC markets, you don't have that much market information. Okay. For instance, like in the less liquid markets, okay. Let's say this is, let's elaborate on this a little bit. So therefore, transparency is connected to liquidity. So the more liquid the market, the more transparent it is. Okay. So there are some OTC markets. Now, why is this the case? You see a perfect example here. Foreign exchange is a very liquid market, the most liquid market in the world. So foreign exchange, you have high transparency. As you can see here, you can see all the prices even for foreign exchange forward. This is an OTC product. Major foreign currency markets, these are all markets, two assets being exchanged for each other. Basically, one asset being exchanged against another money. These are all different types of money. Okay, so this is Danish kroner, Hong Kong dollars. Okay, so now these are all different markets. These are all foreign exchange markets. Foreign exchange forwards, not a very liquid instrument, not as liquid as spot, but still you can see the prices. They are being regularly updated, and I'm not even paying any money to get this information. Okay, I'm getting this feed for free, and it's fairly reliable, okay, because it's coming from market participants. So these days, with the growth of the internet, in the more liquid markets, this statement is not really that true. That's why I should qualify it. that less transparency in less liquid markets, okay, less liquid OTC markets. So now if you're talking about a market for, let's say, carbon black, okay, so there's a carbon black market. There's a market for that, but there you won't get information on the market so easily because that's not as liquid as global foreign exchange. So the less liquid, the less transparency. Transparency means you don't get to know what the price is, okay? So that's basically what is meant by low transparency, okay? So that's another feature of markets. 4 and 5 you already mentioned, and that's basically it. These are the main differences between OTC and exchange-traded markets. So if you can see here in your own, they're pretty simple topic actually, but I just wanted to make sure I go through this. These are your, here I have, okay, I haven't put the OTC link, the picture there. But the point here is to understand is that in the case of, now we can contrast this with the, at least we'll understand the ideas and then we'll see the visualization later. That you can see if you start looking at ET markets, okay, we have OTC, you understood these points. Let's understand how ET markets differ on the two most important features. So let's start with this first, this point of, because our second note is on OTC market, then exchange traded markets. That note is here, okay? Yeah. Here's a picture. This is a picture of the OTC market. This is the bilateral world, okay? In OTC markets, transactions are bilateral. Each person is trading with each other, okay? Now, you will go to exchange traded markets. So this maybe what Siddharth was talking about is something like this, but actually he's talking about a different picture. But in the case of OTC markets, although here they've shown the central counterparty in OTC markets, in the case of exchange traded markets, what's going to happen is there's going to be a central clearinghouse, which is the exchange clearinghouse, and everybody's going to be now trading through that central clearinghouse, okay? So every time there's going to be, a couple of deals. So when earlier A was dealing with C, there was one transaction, one ticket, one contract. Okay, one contract, A and C. Now when A and C deal, they deal through this. So there are actually two contracts, A to CC and C to CC. So one transaction, but actually two contracts. So that's the difference in the exchange traded market. But let's look at the other difference, which is standardized contract terms. A little easier for us to relate to. Let's look at this. You already saw this. Go to you want to understand what it means to have standardized contract terms. Go to the links I gave you. Go to contract specs. The links are anyway for contract specs. Here, see? Straight away you see restrictions, standardizations. If you are trading crude oil futures on the CME, each contract, remember in spot trading, spot equities trading, you had a restriction, a market lot of 100 shares. Okay, now of course they're really diluting all that. We're letting you trade in fractional shares and all that, but we should still think of 100 shares as the market lot for institutional trading in large volumes. So here also you can see there is a contract unit, the market lot. Contract size 1,000 barrels. You cannot say I will trade crude oil for 673 barrels. Not possible. 1,000, 2,000, 3,000, 4,000, 5,000, so on and so forth. Integer multiples of 1,000 barrels. That's your contract size. So straight away you can start to see what is meant by this point. Customized contract terms versus standardized contract terms. Okay, so that is one of the important differences. So you can see in OTC markets you had customization, and now you have what was I looking at? Where did I have that picture? I just kind of lost, anyway, it doesn't matter. Okay, so standardized, okay, oh, I know where I was. Okay, here. So standardized contract terms, we are trying to understand this point. In contrast to OTC, where you have customized contract terms, you have standardized contract terms in ETM. And one example of that is here, okay, where you can see first standardization that is readily apparent, contract size. Price quotation also is standardized, okay, trading hours. Here, there is no trading hours business. These guys, BNZ, Wellington, Night Desk, you can call them anytime. Sumitomo Tokyo, you can call them. Nobody's going to tell you, why did you call me now? The market has closed. Nobody's going to ever say that, okay? They'll quote you prices. The desk may have closed, in that case is different, but the market doesn't have a formal closing time, okay? So here you have trading hours, the contrast, minimum price fluctuation. There is a rule on this. In the OTC markets, you would have noticed now we are trading into 5 decimals in foreign exchange, spot foreign exchange. We are trading up to 5 decimals, okay? Maybe you'll see it, I don't know, maybe if you have it here, but certainly you'll see it on the IB prices. When you see foreign exchange, spot foreign exchange on IB TWS, you'll see 5 decimals. You see here now, 5 decimals, sterling US has gone to 5 decimals. So your class, so we have got, congratulations, your class is up, okay? So you can look at this as well. But you will see that here you have 5 decimals, okay? Sometimes quoting in 5 decimals. There's nobody coming here and saying that you can't quote in 5 decimals. You have to only quote for minimum price fluctuation is this much, okay? So these are you study this. So the first thing you see is customization of standardization of everything is locked down, okay? Everything is locked down. What you can do, delivery procedure, delivery period, what is the grade and quality, everything is locked down, okay? So study this, and then we'll study, next class we'll cover this credit risk management part. So the class is dismissed. You guys can leave, and if anybody has a conceptual question, they can ask me. Yes, anybody? So the rest of you can leave. Anybody has a conceptual question? No? Okay. So we can close the class. So I'll just stop my sharing. So our next class is in the new year, okay? Is that right? So I'll just wish you guys a happy new year. And
Thank you, sir. Same.
yeah, I'll see you guys in 2021. Okay? I'm stopping.
Yes, sir.
Okay, take care.
Thank you, sir.
Okay. I'll stop the sharing and I will